Hi, Andrew here. I want to record a quick video because several clients have been in touch, somewhat concerned about what they've seen in the media about the expectation that pension lump sums will be capped at a certain figure. So any amount over that cap you'll be paying tax on, and therefore it's now a good time before the budget to take out your lump sums and while you can have that higher maximum, potential maximum. So the purpose of this video is to hopefully assuage those fears and explain why it quite probably won't happen, and even if it does, why the alternative isn't necessarily better. So let's start with a bit of context. I've been in financial services for nearly 25 years now. And in that time, it feels like in the run up to every budget, there has been speculation that the Chancellor at the time will do something to limit the tax relief on contributions on the way in, or limit the amount that you can take out tax free when you get to retirement. It has never happened. Last year, the exact same speculation was rife again. Rachel Reeves didn't hit the pension lump sums. She did bring pensions into our estates for IHD purposes, which was a big change, and will bring in billions for the government, not only when people die and pass on their estates, any excess above the nil rate band will be taxed at 40%, but also in people's lifetimes, they're more likely now to start drawing on their pensions, creating taxable income for the Treasury. But in the run up to last year's budget, a lot of people, either on their own or through their advisors, took action that they later regretted because they couldn't undo it. And both the FCA and the Treasury have announced that any action that's taken is irreversible. You don't get a cooling off period to say, well, I took my lump sum out, but I want to reverse it. Once you take it, that's it, it's done. So you have to think very carefully about taking any action that you now that you might later regret. And let's also think further about the context. The state can't afford to have too many people in retirement reliant on state benefits alone. It'll cost them billions, and will be disastrous for the economy. So they need to make sure there's an incentive for people to save for their retirement off their own backs and build up their own pension funds. They've done a lot of that through workplace pensions, but the more they do to chip away at the trust in pensions, like having lifetime allowances and then taking them away and reducing the amount you can put into your pensions, bringing pensions into our estates, it just erodes that trust and people are less likely to do it, which they can't afford. So a strong argument to say Rachel Reeves probably won't do anything. But let's say she does. Let's say she does put a cap in. It's been speculated it could be as low as 40,000. That's very unlikely. Other numbers have been around the 150,000 mark. There is a cap currently, £268,275. Bit of an odd number, and it's 25% of the lifetime allowance that was in effect before that was abolished. So it's 25% of 1,073,100. Another random number. It would be very helpful if the Treasury just set more reasonable, realistic round numbers for us to work on. But that's why we've got a cap of £268,275. So anyone with pension funds above that 1.73 million mark will be paying tax on lump sums they take out beyond that. Let's say they put in a cap of 150,000. That means pension funds above 600,000 would start to be taxed on the excess lump sum they took out above that limit. You've got to think then, well, what am I going to do with the money once it's taken out? You've got broadly two options. You could put the money into savings where it's nice and safe, but it won't keep up with inflation, so the real value of your money is eroding over time. And you're also going to get taxed on any interest you receive anyway. So currently the savings rates tax thresholds are £1,000 for basic rate taxpayers and £500 for higher rate taxpayers. The larger your lump sums, the more likely you're going to exceed those thresholds and pay tax on the interest anyway. You could also put money into ISAs, of course, but that's 20,000 a year, whether that's into cash ISAs or share ISAs. There has been a lot of speculation that cash ISA limits will be reduced. Whether that'll happen again, I'm not sure. Wait and see. Probably not, but time will tell on that. But let's say you decide to invest the money instead because you want your lump sum that you've taken out of the pension to grow as it was growing in your pension fund. So you can put £20,000 into a share ISA, tax-free, no tax on income, no tax on gains. But the excess, any money you put it, you're investing beyond that, has to go into general investment accounts, unit trusts, where you'll get taxed on dividends you receive, interest you receive, and capital gains. And those, particularly those income payments, they're payable whether you actually physically receive the money into your bank or not. Any income that's generated, dividends or interest, has to be declared. There are the annual dividend and capital gains tax rate, as well as your personal allowance for interest, but they'll quickly get used up. And as we've seen, tax thresholds have been frozen. So you've got this stealth tax over time as our income increases or our growth in our assets increases, more of them are going to be liable to tax. But it's quite possible they're reduced further anyway. So what you're going to end up with a large pot of money in a less tax efficient investment than it was in with a pension, where it's growing tax free. Over time, you put £20,000 into share ISAs to get it more tax efficient, tax free, but that's going to take a long time. And in that time, you'll be paying tax on interest, dividends, and gains. So the point is that you're potentially moving from a very tax efficient pension to a less tax efficient environment. And so you'll be possibly no better off, possibly worse off. If you're going to be better off, you just have to be very efficient at managing the money. But that's very hard to do, particularly if you're managing the risk within the portfolio and rebalancing it to make sure that the overall mix of the assets remains as it should be. You're going to be using up your capital gains tax allowance each year doing that. So it's going to be harder and harder to move money over time into ISAs, particularly the bigger the pension lump sum you've taken out. And the other thing to remember as well is when there are big changes to pensions like this, it has to go through Parliament. It has to be turned from the Finance Bill into a Finance Act, which does take time. So it's not that Rachel Reeves will make an announcement on the 26th of November and it will become law at midnight, as a lot of the budget announcements happen. The last changes to the bringing pensions into inheritance tax environment took almost a year before actually it was finally announced, and that's not coming into 2027 anyway. So we've got time. If your plan doesn't change, there's no need to take short-term actions. Pensions remain very tax efficient. We will adapt and react in a calm and measured manner when we know the full facts. We certainly won't take any action based on speculation. So I hope that helps. If you've still got questions, please do get in touch and I'll happily talk you through it further, and we can come up with a plan that is specific to you and your needs and your priorities. Thanks for watching.